Welcome to Street Smart Success. This is Roger Becker, your host. Street Smart Success interviews real estate entrepreneurs across all asset classes and markets. Learn with me as I drill down with guests on what it takes to be successful in the world of real estate. So today we have with us a guy that is so smart. He is back for round 2 on Street Smart Success. We've done a little bit of business together since we did our podcast a year ago, and I have nothing but great things to say and great experience. He has flipped so many homes. He buy and holds so many homes. He is a lender and just his just really kind of followed the breadcrumbs in such an intelligent way. I have nothing but respect for the owner of OCG Properties. He is Matt Owens. Matt, welcome back to Street Smart Success.
Thanks, man. I would say that I'm not that smart. I've just taken a lot of punches and a lot of hits to learn a lot of lessons along the way, So
You know what? I saw a meme on Facebook that basically said, it was Michael Jordan said, and I don't remember the numbers, but the gist was the ball has been passed to me 26 times to make the game-winning shot. I missed them all. I have missed, 3,000 baskets. I've failed here, I failed there, and that's why I'm successful.
You just keep standing back up and standing back up and standing back up. You can't fail if you don't stop. So, at the end of the day, that's really what it comes down to. It's that mindset shift, which is actually like extremely important, not just success with business, but obviously in real estate as well. And being able to let those losses kind of roll off your shoulder a little bit, or emotionally roll off, to be able to say, no, I'm not going to let that change my focus away from, what I'm trying to accomplish. Right. Like, and making sure that those curveballs, those, punches here and there are going to be thrown at you either way. It's just a matter of, in life in general, not just business for sure. And the life ones will really throw you off track, of course. But, at the end of the day, it comes down to that mental focus and, honestly, standing up a few times. Once you stand up a few times, it's pretty amazing. I actually remember back when I was about to take a $50,000 hit on a multifamily building. It was a much bigger renovation than I thought. It was one of the first multifamilies that I renovated. And it was like, 1918 build. And the thing was a mess, right? They're trying to repair plumbing and it's falling apart in their hands. So they had to replace the whole thing, right? And I was only going to take a $50,000 loss, shockingly, on a deal like that. After fixing it fully and then having it moved to a 1031 exchange client and things like that. And I remember telling my wife, put your hand on my chest. I'm just stressing about this. This is a big deal, to me, massively, 50 grand. And I remember the next day going, okay, I think I listened to some, motivational educational podcast or something like that. And all of a sudden my mindset shifted into, okay, what am I going to do right this second to try to make this money back immediately, so I don't have to let this bother me and get to me, and I can pretend in my head like it's just a wash, And I remember going and saying, okay, I need to find a bigger deal that I can go and make this money back on. And who do I know that's looking for property right now that I can help them acquire something? And I had two other 1031 exchange clients that I just called, and and I went into one of my other previous relationships that I was already working on this deal for, that really wasn't working for my numbers, just to buy it and take it down and renovate it all myself and everything. But if I was to move it right away to one of my investor clients and take a wholesale fee in between, but also make sure that my investors were taken care of, the renovation management was in place for them, the managers were in place for them, we had the full rehab bids, the whole 9 yards, handled and managed for them, so they didn't have to do it, then I could make a $70,000 profit. And I literally got that under contract the next day after that. And at that point is when you just know that it's a mindset issue. Now, not everything's going to be that easy to go make. It wasn't necessarily easy. I had been setting the tone for that with my other clients and the buyer, the sellers of this building and things like that for a few months already, right? It wasn't like it was just out of the blue, hey, that came up, which could potentially happen as well. But it was an interesting shift in me personally where all of a sudden I was like, this is the way you have to be thinking anytime you have a loss. Because I had taken losses before and let it affect me for weeks, where it's just like, oh, it just hurts you. So, but at the end of the day, that shift is so key. I think it's probably because your head is up and you're looking for those opportunities and looking around and things like that, and saying what's available out there for me to be able to do this with, and just looking for the solution versus dwelling on that problem and letting it affect you emotionally. Sorry to go off on a tangent. Obviously this is real estate stuff that you deal with.
Well, are you familiar with the law of attraction?
Oh, for sure. And it's funny, I told my mom about that book and I showed her the movie where the kid just wishes for a bike and it appears. But the whole idea is you're supposed to be focused on it and focused on it and focused on it. And finally you achieve it and get it. My mom's mentality was, you can't just wish for a bike and have it show up. I'm like, actually, you can, mom. So, but
Well, you know what? It's like if you ever want to know where you are in life, shy of, health wise, or you're in a war zone, clearly, right? But if you're in the United States and you're like us or whatever, uh, if you want to know why you are where you are at this very moment, all you need to do is just go buy a mirror and look in it, and there's your answer. We attract
absolutely.
what we think about, and that's everything in our life is ultimately a result of what we think about. But yes, no, we're here to talk about real estate before we bore our listeners too much further. So, my friend, you've got a debt fund, you've got buy and hold properties, 1,400 ish, 1,450 of them, and you flip properties. And I am going to roll the wheel, and we're going to start at the debt fund.
Cool.
Okay. So, I watched you last evening, and ultimately you were doing enough business with guys that were, I think, wholesalers. Feel free to correct me if I'm wrong, but you realize, why don't I lend these guys the money? That opportunity presented itself. And it may not have been that simple, and you can elaborate. But what's so interesting to me and so impressive at the same time is that you're down in the southern part of the great Golden State. I'm up here up north, where it becomes very socialist very quickly. But anyway, I digress. But you're down there in the OC, Orange County, and you're doing this in Indiana, Tennessee, Missouri. So what do you do to make sure a guy that you're doing a loan with pays you back? Because it sounds to me like the diciest thing in the world, but I know you've seen the movies and every ending, every middle, every beginning. But how do you do that?
So, after flipping 1,000 houses, 1,000 ways of losing money on a house, including dealing with joint venture partners, including dealing with team members, and what's the right quality control to put in place. And so, for example, when we're flipping a house, we're buying it, we're renovating it, we're tenanting it, we're getting a quality control package together where we get inspections before the renovation is done, after the renovation is done, and then punch list items, and then additional follow-up inspection with an outline of all the major systems on that asset, so that or we know that this job was done right. And that was born from people telling us things were done and then they were not. And then you just have to pay for those later, right? So, or it's done wrong in the first place, or they missed it because they put lipstick on it and didn't touch the systems. And you never really know exactly how old they are. And so, this was born over a period of time, and having secondary, I guess, segregation of duties with an outside parties checking on your teams and things like that. Whenever you're investing in a different market, I would say if I'm investing an hour away from me personally, then I'm investing in a different market, because I don't want to be the one driving to that house. I don't want to be the one going through and do that. It's not possible to scale to do any of that stuff. And it's not worth my time to be able to do that when I can pay somebody a small fee to go by there, get me all my pictures, give me a walkthrough video, have them be a licensed inspector, so that way you get all that documentation. So typically when you're analyzing a deal from a lending perspective, not only are you analyzing that property the same way and saying, okay, well, what's the market value? What is their all-in cost with purchase, renovation, closing costs, insurance, property taxes, the points or the lending fees and things like that involved? And how much money do they have to put in that game to make sure that I'm comfortable lending them money as well? And so, typically, if you're looking at any market value, most lenders won't lend more than 70 to 75% of the market value. A lot of times we're at like 65 to 70%, just to be on the safe side when you're dealing with construction loans. And so what we do is we vet the property, make sure it's a good deal. Then we vet the borrower with background checks, criminal checks, make them show us their previous deals of what they've done with their numbers and their breakdown of those deals, and what showing that they were on title, their entity was on title with those deals. We're also making sure that they have enough cash reserves, that they have the right renovation team to be able to do these items, and how have they used that renovation team in the past? Have they been successful, and do they have a backup if something goes wrong? In their renovation bid, does it include everything that we're seeing on the property as well by doing our inspections and looking at all the factors involved in that? Does it look like they're missing anything on the renovation side here from a total property standpoint, where you're dealing with all major systems, the roof, plumbing, electrical, HVAC, water heaters, all of those things? And then, so once you vet that property, the deal in itself, make sure they have proper renovation buffers built in, make sure they have the cash down, they have the interest payments. Then we structure the loan, and say we do something at 65% of the market value, and they're looking at an all-in cost of 75%, then they're typically putting that down payment difference down. And in addition to that, we hold back 100% of the renovation, and typically we'll hold back 6 months of interest also, so that we don't have to worry about getting monthly payments. I've had lenders tell me in the past that that's not smart because you're losing out on late fees and things like that. But to be honest, I just don't want the headache. I have a 4-year-old and a 7-year-old, and I don't care. I don't want, if I have borrowers that are late anyways, then I'm not going to do business with them long term if that continues. And so I'd rather set them up for success and say, hey, you're going to put that interest in up front, and we'll credit it every single month towards that project until it's complete. And then once that happens, then you start making payments, and we'll usually do like a 1-year loan on the deals, because me as a flipper, I hate that super tight time frame that stresses me out sometimes. If you have a city issue where you can't get something permitted right away, or a COVID thing happen, or any little thing come up, it could delay your project, and you're just stressed and running around like crazy. So I try to give people a 1-year term on the financing. And so what we're doing is we're vetting the borrower, we're vetting the property, we're doing the construction hold. So they put the money in, get us pictures and video of the property along with the receipts, and then we go do an inspection if the bid is big enough. If it's like a roof or something and you can see obviously that the roof has been replaced, then we don't necessarily send a full inspection team out there for something that minor. But we'll go through and document that whole process and do a reimbursement system, so that at the end of the day, we end up with a fully renovated property, and then do our final draws on the renovation to reimburse them for those final costs. And now we're into the property with a a maximum, call it 70% loan to value or 65% loan to value loan, and a finished product. And now they're either reselling the property or refinancing it as well. And in this kind of market, we're being a little bit more conservative on the values because we're seeing some volatility due to the interest rates and some softening of the market. It depends on the state you're dealing with, of course. A lot of the volatile markets like the Arizonas and the Californias and the Boise, Idahos, they're having more volatility because they were at max affordability thresholds versus a lot of the Midwest markets that I invest in, that I lend in. They has a higher cash flow as far as the cap rates at my foreclosure costs if I had to take them over, but they're also less volatile. So, they might go down and up by 4% a year. And I'm also monitoring the inventory supply very closely in those markets to see, what has occurred in those markets over the last few months and, that type of thing. We're just seeing a little bit of softening. We're not seeing majorly, price issues and things like that yet across the board in most of the markets. So, in addition to that renovation process and system, we go through and make sure that we're doing our checks and balances, making sure that we're analyzing the property from a cash flow perspective, because if we have to take over that property, we want to know how much is this cash flowing. Am I foreclosing at an 8 cap? Great, no problem. I'll hold it for cash flow then. Awesome. If I needed to. And don't get me wrong, I don't want to deal with that, and deal with the headache. Lenders normally don't like to have a property get back in their portfolio. But if it was to happen to me, then great. We've had no foreclosures inside of our debt fund or anything like that so far, but we have had them outside of it where we own a lot of notes in our own personal name and things like that as well, where we've had a few foreclosures and we've actually done some deed in lieu, which are the best way to take a property back if they're coming up with problems. So we're very, very communicative with our borrowers and saying, hey, are you good on cash flow? Do you have enough? Is there any rehab overages on every single construction draw? We're asking for their estimates of any issues that are coming up and trying to communicate with them every single at every single point, so that way we know, do you have enough cash left? Hey, here's your new numbers now. Are you going to even come up with paying the mortgage off in this situation if you were to sell it for this price? And so a lot of times, if that occurs, they'll go and sell it and things like that. But other times we'll go through and just say, hey, why don't you just deed the property back to us? Because at my cost, I'm good with holding it for cash flow. And I have other investors that are interested in that cash flow as well, because we've been selling turnkey properties to investors for 15 years and have a massive base of investor buyers that want to buy properties. So these are all the ways we mitigate the risk, investing in the right markets that are low volatility markets, high cash flow markets, lower loan to values, doing background checks and vetting that borrower really well, vetting the property and making sure we get appraisals on each one of the properties every single time. And then that quality control process through that process to make sure that you have a good asset long term and that you end up with a fixed and finished property. So that's kind of the risk mitigation strategies that we deploy across the board for the most part.
Okay. And so just to clarify, so, if it's $100,000 house, you will lend them, let's say 70 grand, and they have to come up with 30 grand. So they've got some skin in the game. Or do they typically, do they go borrow that somewhere else, or who knows?
So typically a better scenario, if it's 100 grand, their all-in cost is 75 to 80% or 80 grand, and they're going to go flip that property and make a profit or refinance it and hold it themselves for cash flow. And in that kind of situation, we're typically looking at a max loan of like 65 to 70% of the market value. So they're putting about 10% down in that situation, or sometimes 15. And then they're also putting up the interest for the entire project based on the renovation budget. If it's a small, $20,000 rehab or something like that, then might hold 3 months of interest. If it's a bigger rehab where you're looking at $50,000, $60,000, then we're going to hold usually 6 months of interest, just so that even though 50 and 60 is not that big of a rehab nowadays, with cost changes. But so that's typically what we're doing as far as their down payment.
I see. What kind of stuff? First of all, who at Owens Capital is the one I guess that's doing this vetting, that's looking at the guy that's buying the house and making sure that and looking at the deal, vetting the operator in the deal.
So we have processes and procedures in place and checklists in place to go through every aspect of this. So I have certain team members checking on certain aspects and getting the files ready and things like that, and then I have other team members doing the actual property analysis. So we do an upfront preliminary analysis before we go send it and say, here's what our estimated loan is to the borrower. And that's one of my key underwriters on my team that's been working with me for 10 plus years, that consistently is underwriting our deals and things like that. And then I do a final underwriting afterwards on each deal that comes to the door, where all the documents are ready, but we already have the appraisal back and things like that. I'm mostly looking at the renovation and the borrower and the final comps to make sure that I agree with the appraiser, because sometimes they're wrong. I agree with what the renovation bid looks like. And then I agree with, hey, is there anything major that came up from the borrower that one of my team members missed across the board, and doing that. So, and that's mostly just because of my experience on the renovation side and seeing this and mitigating risk. If it takes me 10 minutes for each one of these loans to review those things consistently now, maybe 15 minutes, it's not that much workload for me to make sure that I have really good quality control, even though technically I shouldn't be doing, the operations aspect of this. But when it comes, this is one of the reasons we don't have very many foreclosures, if any, so it's because of that. And me saying, after taking a few, hits on a couple of the loans where you're like, that guy just totally jacked us and stole from us, then you're like, let me just pay attention, because one loan that costs you 25 grand and a haircut or something like that, makes you take a step back and say, wow, that's this much time frame of profits that we just lost that I don't want to lose,
Yeah.
so
That's 10 minutes well spent.
yeah, absolutely. Right. So much better than the $1,000 an hour that I tell my brother I'm worth, that he gets mad at me about. He's like, you need to do that. If it's $1,000 an hour, you need to do it. And I'm going, no, that's my threshold. I'm gonna sub out everything else.
Hey man, it's worth, what I'm hearing is worth more than 1,000 an hour.
Yeah,
Uh,
exactly. So
and then how do you find these? How do you find the borrowers? Or how do they find you?
so we what's great is that when we were selling our turnkey investment properties a lot more before I started just holding a ton of them, and putting deals together where I'm structuring these with bigger, larger private investors so I can hold them and things like that. We would use an affiliate system. So we had affiliates internationally in Japan and China. We had affiliates that here in the US that knew our reputation, knew that, hey, we're going to get them a deal that's super clean. And guess what? If there's a problem after the fact, then we're going to fix it for them. I put aside $2,000 on every house, even though we have those quality control procedures in place, to make sure my buyers were taken care of for stupid things that come up. Like we literally had a car from, we had one house that we sold that was on a major street. A car ran into the house. $500 insurance deductible, but so we just covered the deductible for the investor, so they were taken care of because they bought the property 3 days before. And I'm like, did that just happen 3 days after they closed escrow? And then there's other things where the line that we scope the line to the street, everything looks good, but then at the end of the day, the line breaks right after the tenant moves in. We have to move them to a hotel, rip up the kitchen floor and the tile, and redo all that stuff. And it takes a few weeks, and costs $5,000 to go redo all that stuff. And we just cover that for like our buyer on the back end. And so we had all these affiliates set up that were selling our projects, mostly licensed realtors and things like that, that were helping sell our products or educate our clients on these things. And we had a process to do that through our affiliate structure. And so we just basically duplicated that process, but on the lending side. And so we have hundreds of affiliates out there that bring us deals over and over in an online submission system. And what's awesome about it is that we pay it in perpetuity. So we pay typically a fee each time. So someone comes and submits a deal to us and they have an affiliate ID set up, and then every borrower has a borrower ID. So they get, anytime that borrower borrows from us, even into the future, they get a piece of the profit every time. And there's no end date involved. I don't sit there and go and say, no, this is only for 2 years or this is only for 5 years as a limitation. My goal is to have my affiliates set up a cash flow stream so that they can retire off of and depend on, where if they get a certain economy as a scale, they're making 10, 15 grand a month consistently by having that scale. Now, it's not easy to build the scale because investors and flippers and holders, there's not that many people out there that are doing volume every single year. Maybe there's someone doing one a month and they might take 3 months off or something like that. Or, there's someone else that does one every 6 months. So it's a massive volume thing. And then also being able to continue to remarket to all those borrowers to make sure they don't forget about us. And then we also do a joint venture program that's been crazy popular, where we would put up all the capital to the deals, and we would split profits with the flippers and the holders on the ground. After a preferred return is built. So through that affiliate system and some of our unique lending programs, where we're not only lending money, but we'll also joint venture and do these other strategies and work on multifamilies and that type of stuff as well. We have a wide range and a wide net for these affiliates to be able to market to be able to make money with us by bringing us relationships. That's all real estate is how do you help each other and bring each other relationships? And it's a matter of the structure, because a lot of people structure this stuff wrong. And I was like, this needs to be in perpetuity so that way there's a massive long-term incentive here for that, long-term, relationship build. So that's how we structure most of the marketing. We've been doing some online marketing now. I just started a YouTube channel, so just to help people and things like that. And that'll bring in lending. That'll bring in people to our course that we're setting up right now. That'll bring in people that have capital. That'll bring in other deals and syndications that we can invest in, or different operators in different markets. All we're looking for is resources that we can then go categorize and develop relationships with long term to find the right people to work with. So that's all this is about in the first place. So
Matt, how many people, just out of curiosity, and you may have a sense of this, maybe you don't, how many lenders in this space are there at your scale in the country, or do you have no way to really nail that down?
So I'd say 90% or more of the lenders don't have their own capital, and they're just brokers involved that are utilizing other correspondent lenders. And we even broker some loans off as well, because I like the cookie cutter $200,000 to $400,000 loan, or $100,000 to $400,000 loan in the Midwest that has cash flow, because I know that product really well, and I think I can have a well diversified base of loans, right? So that's my bread and butter, to be able to want to fund and internally ourselves. If you're dealing with a package that's a $5 million package of loans, or a larger multifamily, I'm going to typically take that out to one of our correspondent lenders or something like that, just from a risk perspective and a funding perspective and a diversification perspective on my side. And so 90% of the lenders that's all they have. That's just direct to correspondent lenders that are these bigger giant outfits that have the Wall Street money, basically, that do these directly. And they utilize these brokers to be able to bring them business and consistently utilize their funding. And they'll usually make a point on the transaction or something like that, and then maybe a yield spread on the back end in some instances, which it seems like a lot of that is going away as the market shifts. Right now, we're seeing an increase in interest rates, and as well as an increase in points and fees with those correspondent lenders and things like that, mostly because I think they're kind of wanting to get quality instead of quantity and things like that as well. And so I'd say there's 90% is that space. The rest of them are the very big institutional guys, and then the people like me that have funds set up and other outside avenues where I have my fund. I also have outside note buyers, banks and insurance companies that buy notes from me in $2, $3, $5 million packages of these notes, where I just make my yield spread on the back end of those deals. And I basically sell it to them at one rate and lend it at another rate. And that's how I make my money on the interest rate spreads. And we have about 35 million right now lent out to flippers in different markets around the country that we're making these spreads on. And I have about 10 million in my fund that I utilize over and over and over again. I just don't raise a lot of money for that fund, just because I just don't focus on it. I'd rather sell off a giant piece of of these investments to outside borrowers, because it's just a risk mitigation tool to not take that much on our shoulders all at one time, and we still service them and do that kind of stuff for those outside buyers. So
Very, very top level, and I think you've said this publicly, so I don't think I'm going to a place that you're not comfortable with, and if you are, just tell me. But I think, you're lending the money at 12, and you're paying your investors 8, so 4. And so on that 35, you essentially about a mil 4 in revenue against that product, essentially.
Yeah, some of them were lent at 10% rates, and 10 to 12 is typically what it is. Sometimes we have some very big borrowers, and I have a borrower in Tennessee that does massive volume, flips 300 houses a year, type of deal. So we have special programs for that type of relationship, of course. But yeah, that's generally what we're doing on that side. Plus, and the points and fees and things like that that we charge typically pay for my team and the overhead involved. So that yield spread is typically our profitability on the back end and how we make our money at the end of the day. Plus, we have our flip business, our hold business, our multifamily value add business, and then we invest in a lot of syndications and things like that, and other outside opportunities that we've actually invested in ATM machines and the cannabis space, and other debt spaces and things like that as well, or more up and coming startups that maybe not full startups, but are still in their growth stages, but smaller chunks of money in these where we can put in and diversify our base of cash flow.
Let me ask you this, and you're jumping ahead, but that's okay. Um, so I've learned to expect this from you. Okay, so my question is, given what you've done as an operator and as a lender in the single family space, with just a tremendous amount of experience to, in my mind anyway, how does that play into how you vet multifamily syndicators? Because I know you've invested in some of those. Like how then do you go, I would never invest in this company in this deal, and I would invest with this sponsor in this deal?
So I think one, you can do the background checks. They're usually clean with a lot of the operators out there. You're going to go through and, I kind of take the lending guidelines that we kind of put in place and kind of extrapolate them into this space as well. But I'm also, because I'm, not operating it myself, I'm looking at who is their managers on the ground in these markets, who is their construction team, do they have experience with these people, what kind of platforms do they have set up, what kind of communication skills do they have, what do their reporting look like from a financial reporting standpoint. You're kind of almost vetting an operations team, including a property management team, which every market that we've been through 5 property managers, before we start and find the right ones. And so at the end of the day, it's a matter of, hey, you got to vet the management team that's on the ground, that they're utilizing as asset managers for this and operations managers for this asset. You have to vet the operations managers' skill sets and their, compliance and quality control procedures and things like that. And then you have to vet the actual deal in itself, right? You're looking at, and from the deal standpoint and the risk mitigation standpoint, that's where my operations side really steps up game, where we're seeing where the risks really lie. Like on a multifamily, for example, one of the biggest things that I'm really focused on is the risks that I see in the market right now, and has that operator considered those risks. So, for example, a lot of syndications in the multifamily space come down to a purchase with a renovation, maybe a short-term bridge loan, and then refinancing and pulling out a bunch of investor capital into a long-term loan after that, right? And if the deal doesn't pencil or doesn't work, where upon refinance the interest rates have gone up 2%, and and what does the rate look like? What does the cash flow look like? What does the leverage ratio look like at that 2% level? If it doesn't pencil there, or the deal falls apart, or it's negative cash flow, or the deal is just really, really low cash flow, and then typically I'm not looking at that deal anymore, because I really believe that, we may very well have an increase in interest rates, and we sure as expect it right now after what's occurring, with inflation, right? And so, and what the Fed has been doing previously. So I'm looking at the risks of the market and saying, hey, that's a big risk, or is it a deal that they are buying a property, has minimal renovation, and they're just raising cash for the renovation, and they're getting a 7 to 10 year loan now, and having that stabilized, in place. That to me right now is a lot less risk because of that interest rate risk, than the typical short-term loan up to refinance, afterwards, right? And then on top of that risk, you also have the risk of, right now we've had massive rent inflation. I personally think that rents will continue to increase, because as people get pushed out of the home ownership market, as interest rates increase and affordability gets squeezed, they get pushed to become renters over here, and then as that happens, rents typically rise, right? So my personal opinion is that could occur. At the same time, typical qualifications for renters as well as homeowners don't include the increase in food prices, don't include the increase in all these other things. So it's extremely important to make sure that they're qualified on the right basis over there. You know what I mean? So that is absolutely key for being able to vet, what's going to really happen in this space. Here's my boy right here. He's came in the to say hi. So,
hey, how are you?
Hi, buddy. This is Roger. We're on a podcast right now. You're going to be on YouTube later, buddy. So
millions of people.
Yeah.
You're in show business all of a sudden.
Millions and millions and millions and millions and millions.
All right. Hey,
yeah, maybe a couple.
Daddy, but the teacher said I have to bring a parent over, and Mom's not here yet.
Okay, well tell her that I can't right now, okay? And she can finish the class, okay? Thanks, buddy.
I am done.
Okay. You can watch TV for 15 minutes.
Yeah, Mommy said when I'm done,
okay,
I can play that.
All right, thanks, buddy. the fun things of working from home,
Absolutely.
So actually I closed my office about 8 months before the whole pandemic hit, just because I wanted to be able to spend more time with my kids and be able to do that type of thing. So it's been a breath of fresh air to be able to be around them and show them different things, and have them make guest appearances on podcasts, so
I'm disappointed that I'm not the first.
So, at the end of the day, when it comes down to the multifamily piece, I'm looking at, hey, what happens if rents drop by 10%? Is that deal still going to pencil? And what happens to our cash flows? Because if, you'd like to think rents are going to keep going up and that kind of thing, but if affordability is squeezed because of the food problems, the gasoline problems, and general inflation on everything else that they're, dealing with, then are they going to be able to afford your rent? Are they going to be able to afford that, continued increase? And so I think long-term, we may have an issue where, rents start flattening out just due to affordability and rents across the board. And so that risk to me is saying, well, what happens if rents drop by 10% and cap rates actually decompress and go from maybe a 6 cap to a 7 cap in a market or something like that, as far as market value goes. And then what does the cash flow look like if the rents dropped and you have, an increase in interest rate over here as well on top of that? That's like the perfect storm, right? If something like that occurred, obviously you have cap rate compression on top of a decline in cash flow, on top of an interest rate increase over here. Are we losing our money? Are we leveraging low enough to where we still are cash flowing and being able to ride out that storm? Because that's what I'm looking for. Can we ride out that storm? Because long term, inflation will probably continue to take off, but I want to make sure that in the short term volatility that may occur, are we going to be okay on a cash flow standpoint? I think that's super important when you're going into investing right now. Is yes, use leverage, because cash flow is, the cash flow is much higher when you utilize leverage, and you're decimating that debt when inflation occurs. Leverage conservatively so that way you're not taking a risk when there is that market volatility. Something I learned after quitting my job in 2006, when right before the real estate market occurred, when cash flows got squeezed, rents went down, everything went down across the board. And if I had assets at the time that were performing better, you could just hold long term and not have to, not have to squeeze every penny out of these things to make that deal work. So
So okay, so I'm going to tie what your theme is, or part of what you discussed, to your lending business is, and mostly in the Midwest, single families, as the is interest rates continue to go up, and then the buyer pool of new homes shrinks, maybe not like in California or Arizona or
right.
whatever, because St. Louis or Indy or Memphis aren't, is volatile. But at the same time, you don't have the incomes, in those markets. How does that, the interest rate environment affect the lending business? If you have some guy, basically go through the whole process, he acquires a property, he renovates it, it's done, and what happens if the property sits on the market? Like, what does the environment do to that side of your house?
Yeah.
No pun intended.
No, for sure. So two things. One, it makes properties cash flow less, right? You have a less return on investment when that occurs. Now, what they've done to kind of counterbalance that is they've introduced interest only terms, like 10-year interest only terms with a 20 to 30-year amortization after that, which means that they're doing 40-year loans now in some cases. And so that actually helps with some of that cash flow mitigation, that change there from a cash flow perspective. Your return on investment is still a little bit lower because you have no principal reduction during that term. But if you're in an inflationary environment, there's no real reason to pay down the debt anyways, because the market's doing that for you. At the same time, so that's on the cash flow side, right? So the people that are borrowing on deals that are then going to refinance them and hold them long term, their exit strategies get a little tougher. Their loan to values might be a little bit lower to make that cash flow work, or something along those lines on their refinance. So do they have additional reserves to cover it if their value drops by 10% during the renovation, is worst case scenario? Now keep in mind, in 2008, when everything went down crazy, it took 6 years to get from top to bottom, and it was average going down in a lot of these markets by 4% a year. And it took a hit in the very first year because of the lack of liquidity in the market, but then it bounced back and was more of a steady decline after that. So for about 6 to 8 months, it took like a massive dip because of liquidity, and then it bounced back to more normal levels once there was financing available again to do that. And so I don't think that 10% dip is really reasonable necessarily. I think considering a 5% dip or something like that is reasonable. But if I consider what happens if there's a 10% dip, do they have the cash to pay us off if there's a refinance, plus the cash to be able to put into the deal if the renovation costs are higher because of inflation on those materials or delays in those materials, plus overages in case the 6 months interest is not enough because of those delays in materials. Sometimes windows take a really long time, or appliances, because of the supply chain issues and things like that. So we're mitigating that risk by saying, do they have the extra reserves to cover if some of these things occurred? And do we lower our loan to values? And which is what we're doing now in a lot of these ways to mitigate some of those risks, to say, hey, yeah, appraisal's here right now, but that's a historical figure. Let's assume when they go sell this that it's 5 or 10% reduction in market value at that point, and be a little more conservative. And then and so that happens on the refinance side, as well as on the flip side. We need to reduce by 5%. People right now, all of a sudden, the sellers aren't getting top dollar for a house that has problems with it, right? That isn't perfect. If a property is perfect, they're still getting their prices. They're not having major price reductions and things like that. It's the ones that thought they were going to get all those same comped prices, but their property didn't have all the bells and whistles perfect on it. Wasn't like the highest quality renovation in the room. And so they're not getting bidding wars, and they're having to drop price to more of a reasonable level based on the quality of their renovation on these deals. And so that is a big mitigating risk factor that we're doing, is we're making sure that their quality of renovation is good. They have the right reserves for these flips. They still are profitable if the values decline by 5% or so, and then we're still at a good ratio or loan to value margin if the values drop by that percentage as well. So that's typically what we're seeing. A little bit more skin in the game, a little bit more reserves, a little bit more conservative on market values when we're lending capital.
Are your borrowers, Matt, are they, what percent do you think of they or them? I wasn't a great English student. Them, I think, are buy and hold, or are they or flippers? Like what percent? How does that stack up?
I'd say 25-75 in favor of flipping than holding. And I try to tell them every time, but my biggest mistake was selling 1,000 houses, like, because at the end of the day, like, if I remember back in the 2012 prices that I bought a lot of these things at, man, why did I just take that 10 to 15,000 or $20,000 profit? I would have made 5 times that now, just by holding it. But at the time, I thought in my head, hey, like, I need the cash. I need to be able to live off of this stuff and things like that, which there's structures out there where you can live off of it and hold it, but it just didn't realize, I just wasn't aware of those ideas at the time, so it's all tools adding to the tool belt.
Well, I didn't know in 1990 that if I would have bought $10,000 in Apple stock, it would be worth, well, the market's down, but Apple not so much. So a year ago it would have been 40 million. But now maybe it's worth 35 million. So, there you go. Not to mention, we've all had those, you look back and everything makes sense in hindsight. So 75%, that's interesting. So about 75% are flippers and as opposed to buy and hold.
We're looking at the average cap rates on our lending stuff, and we're anywhere between 6 and 9% as far as a cap rate, depending on how high end or medium end that property is. So at the end of the day, we're looking at our cash flow mitigation on the back end and saying, if the world crashes and burns and everything goes down by 50%, what's our cash flow look like at our cost to mitigate risk? And can we take those assets and be able to hold them from a cash flow perspective as well as a downside risk protection? So right. I don't think all that's going to happen, but you never know with the government, so, and the Fed.
There's a guy who I'm sure because everybody down in LA. And I don't mind. I'm sure you wouldn't care if it said his name. His name is Moses Kagan. You know who he is?
I don't know.
Don't know him. Wow. Okay. He's pretty. Who knows? I thought he was pretty prominent in the podcast world. And anyway, it doesn't matter what he does. He buys. And I don't know the neighborhoods down there as well as you do, clearly, but he's like, I think mostly West LA, and he does multifamily, value add stuff, and he's buying stuff from like the 1920s, like 100 years old. And, he just says he doesn't, when he underwrites, he doesn't even, of course you have to underwrite for an IRR, but he ignores IRR and he projects no rent increases. And he said, because you don't know if the government is going to be rational or irrational when it comes to interest rates. And what he said, I'm not saying they're being irrational now, but everybody I talked to a year ago about interest rates that know a lot more than I do said, oh, well, they can't because we have too much debt. They can't raise them. And if they do, it's going to be very little. And so all of those people have one thing in common at this point, and that is they were all wrong. Anyway, out of the guys that flip then, which is the largest part of your cohort, what percentage of those are flipping to investors versus homeowners?
I'd say a lot of them are flipping to homeowners comparatively to investors. If they're getting them rented and that type of thing, then they do have investor buyers. It might be 15% or 20% are selling to other investors and that type of stuff, versus the rest of those are flipping on the open market or something like that, but usually in nicer areas. Like we don't lend in the hood at all. I won't deal with any of that stuff, just because of the theft standpoint and risk standpoint. It doesn't make sense. And we don't usually lend in rural areas. We have outside correspondents that'll do that for us as well, because I don't want to take the risk, mostly because it's so hard to find team members in some of these other outside markets. You have less pick of contractors and managers and all that stuff in a rural market than a normal market, I'll call it. So, but yeah, so I'd say it's a smaller percentage, like 10 to 20% or something like that, that are flipping to investor buyers that are buying these things for cash flow, and then the rest are to homeowners directly. And what's cool though too is that if interest rates get a little bit higher, seller financing becomes a very interesting option, because if you're looking at a 7 to 8% interest rate on the back end to that homeowner, but you have your profits built into that, your return on investments in the teens. So it makes a lot of sense. If interest rates go up, just start lending more money, to homeowners instead. Usually you have to bring in, an outside licensed broker to lend to homeowners versus lend to investors, but that's fine. Across the board, it's really interesting, and it allows people to get into properties typically with 10% down and that type of stuff, which is kind of unique. So
I guess how much, and you said earlier that it went down, like there was a big hit the first 6 to 8 months because of illiquidity, and then it went down like 4% a year, and it took like 6 years to go from peak to trough. So I guess generally speaking, how much contraction can occur before the model doesn't work?
So, if we had given in our fund, for example, you're looking at typically 70 loans across the board, and if a small percentage of those, call it 5% or even 10%, go down, it really just takes away to the profitability on the back end, and I can still hit the preferred returns to the investors. It takes away my profitability if a giant big percentage of those loans default, for example, or something like that. Typically, if you have a massive change in the market, we're going to lower our loan to values super fast and say, hey, look, we're going to pretend like this is a 10 to 15% drop by the time you sell this property. So you better get a great deal, or you're just going to put more skin in the game. We'll be loaning at 65-60% loan to value at that case if we start seeing a major change in the market across the board, right? And it's almost like a flip. When you're, flipping a house, you need to be projecting what that sales price is going to be in the future. If you have a 10% drop in prices, are you still profitable? Do you have a 20% margin right now, so that you still have a 10% margin when you sell that thing based on the current comps versus what it might be in the future? So that's typically what we're looking for when we're lending capital, and what we're advising our borrowers to do right now, because they're still putting skin in the game. So we're at a better leverage ratio than they are across the board. So we're trying to tell them to protect them across the board too. We want them to be successful and not lose money on a deal. So if they're coming up with a really, really thin deal, then we totally advise them to not do that deal, or share with them, hey, this is, a big deal that you need to make sure that you're focused on, because this is what could happen, so but we don't know yet.
So you really just need to be mega dialed into the market yourself, to know what to lend, basically,
Right.
Above and beyond what appraised values come in at, right? I mean, and part of it is you've just got to have, these are my words, maybe you correct me, part of it is also knowing where the puck is going. You've got to have a little bit of instinct and feel, because it's not necessarily what is going on exactly today, but 6 months from now too, right?
Yeah, and I became an economics buff, and even though I was an economics and accounting major at Santa Barbara, I became an economics major really in 2008 when the market crashed and I lost everything basically at that time. You start to really focus on economics and finding out where that it was, because I've had friends that saw it coming and saw what was happening across the board, just like they do now to a degree, except it's so much more dependent now, it seems like, on the Fed movement and that type of thing. You know, we could have, and right now too, it's a little bit different of a market than '08 because we've had good loans getting lent out, right? It wasn't just liar loans and all these fixed adjustable rate mortgages and things like that, you know, and people, you know, doing no doc, no income method loans. A much smaller percentage of that kind of stuff is occurring, so you have a lot less problems in the overall market that are occurring because of that. So you have a lesser a risk of a lot of foreclosures due to that factor, you know, due to these adjustable rates, due to some of those things. But I think it may affect the commercial market a little bit more on the interest rate side. But if rents keep getting pushed, then, you know, what's that balance between interest rate increase and rent increase, right? So a lot of times you might end up better by holding that asset long term from a rental perspective, because rents may rise at a much faster pace and you can lock in a long-term rate now at the current rate, you know. So
Interesting dynamic all around. Well, I'm gonna make a proposal to you, and it's that you and I, at some point in the number of months from now, we do a podcast just about your buy and hold, because you and I both are long-winded, and we've already taken up an hour talking mostly about the debt fund.
no problem.
But that's okay. So let's do another one for the buy and hold, and then you're flipping, and we'll put a wrap on it for today's conversation. You're a busy man. How does that sound?
Sounds great. It's always great talking to you, Roger.
Matt, you too, and we'll circle back. I'll try to get you back on my dance card in a few months.
Awesome. Thanks,
Talk to
man.
you soon.
Appreciate it. Great talking to you.
Bye.